Good morning, everyone, and welcome to today's webinar, the 2024 Elections Ripple Effect on M&A, Business Evaluation, Succession Planning, Sunset Provisions, and more. Thank you all for joining us today. DAC and Royer Cooper Cohen Braunfeld are delighted to have you with us. Before we begin, just a few session guidelines. Number one, the session is being recorded, but everybody's microphones, except for the four of us, are muted with cameras off. If anyone has any questions, and we strongly encourage questions, please submit them via the chat function in Zoom, and we will try to respond to all of them at the end of the program. We'll leave about 15 minutes for questions. We are excited for today's session, examining what the recent election means for you and your business and how to navigate potential changes ahead. We're going to delve into economic impacts, M&A and tax considerations, the M&A landscape for middle market businesses, and more. I'm Neil Cooper, your MC for the morning. I'm a founding partner at Royer Cooper Cohen Braunfeld, otherwise known as RCCB. We're a full-service law firm with offices in Philadelphia, Conshohocken, and New York, serving clients in the Mid-Atlantic region, across the country, and across the globe. From corporate and M&A to tax, real estate, employment, litigation, IP, private client services, banking, international, and more, our mission has remained steadfast since our founding in 2012. We empower the ambition of our clients and our team. That concept drives our growth and defines our partnerships, and we're committed to providing the insights and guidance businesses, executives, investors, and individuals need to reach their goals. I'm joined today by my colleague Dirk Simpson, chair of RCCB's Private Client Services Group. We're also co-hosting and presenting with the DAC Group, represented by COO Jason Bernstein and Managing Director Steve Raymond. Dirk, would you start us off with a brief introduction, and then Jason and Steve will follow?
Sure. Thank you, Neil, and welcome everyone to today's presentation. Really looking forward to getting into these discussions. They're certainly a prelude to the discussions we're starting to have with our clients. As Neil mentioned, I'm the chair of our RCCB Private Client Services Group, which comprises a team of 7 of us helping business owners, entrepreneurs, and investors largely with navigating both their estate tax planning, gift tax, as well as income tax planning. Some of those issues, of course, are terribly relevant today in the context of where things might be going with tax policy.
Thanks, Dirk. And Steve, do you want to introduce yourself and DAC?
Hi, my name is Steve Raymond. I'm with the DAC. I'm the managing director with the DAC Group. And for those of you not familiar with DAC, DAC is a 40-year-old, 30-person investment bank. We are headquartered in Bergen County, New Jersey. We have offices in Chicago, Southwest Florida, LA, and in Philadelphia. We provide M&A advisory services to closely held and privately held businesses throughout the area. Thank you.
Thanks, Steve. And Jason, do you want to introduce yourself?
Absolutely. I am the Chief Operating Officer of the DAC Group, and I'll share with the crew that I have a somewhat unique background in banking where I spent most of my career as an operator and serial acquirer. So I have over 100 transactions under my belt, often as an operator, similar to the folks joining us on this webinar. And excited to have some more clarity over the last week because we've been getting these questions for months, and they were very difficult to answer 3 months ago, and have a little more focus now.
Thanks, Jason. Indeed, we have a lot of questions that have been answered, but some still open. Now that the election is over, some of the media outlets are saying that the Republicans will have control of the House in addition to the presidency and Senate, but that's a little bit unsettled, and President Trump's appointments are coming out very quickly. I don't think he's done some of the economic appointments yet, but so those are to be seen. But I think we've seen some of the candidates, a lot of folks from potentially from Wall Street for Treasury Secretary and some of the other slots. So with the overall state of the country and the economy and the political background, I wanted to kick this off by talking about the overall state of the M&A market for middle market businesses now, and how we project that playing out over the next year or so. And Steve and Jason, if one of you wants to kick that off, I think that would be great.
I'll start. So
Okay.
2024 has been a very robust M&A market. 2023 was a bit slow. There was a lot of activity, but not a lot of closed transactions. And what we've seen in 2024 is heightened demand, quality sellers, and a lot of successful transactions. And I see no reason for that not to continue and to continue to grow into 2025. Nothing, as long as nothing too dramatic happens. Part of the reasons for that were on the buyer side, the strategic buyers were starting to get more comfortable, less uncertainty in the market, and more comfortable with getting a little further outside their core. And I don't see that necessarily changing in the future. And the financial buyers were getting more comfortable with the higher interest rate markets. They were sitting on an awful lot of cash and wanted to put that to use. And both those folks were much more acquisitive in 2024. Another thing that we saw quite a bit was the overhang from COVID was starting to disappear. So when buyers were looking at sellers' numbers in 2023, they didn't know what to compare them to. They didn't know if that was the new normal. And they would want to compare that with 2019 because 2020, 2021, 2022, there were so many confounding influences and noise. They didn't know what was the business would look like going forward. In 2024, that uncertainty and that apprehension largely disappeared. So those fundamentals I don't think are going to change. And in fact, I think they're going to continue to strengthen over the next year. Steve, any specifics on the Trump administration?
Thanks, Jason. I think it's always important when you talk about the transaction market in general to bifurcate the transaction market. There's the large market deals, which you read about, the deals you read on the front page of the Wall Street Journal. That market goes up and down. There are cyclical swings to it, as well as volume swings and valuation swings. But the vast majority of the transactions that get done in the U.S. take place in what we all call the middle market. The good news and bad news in the middle market is it's steady. It's steady. It's been steady for 30 years. Valuations don't change that dramatically. Volume doesn't change that dramatically. Companies that are looking to transact aren't looking to take time the market to focus on a sudden spike by one or two companies. They're focused on selling their businesses for other reasons that have very little to do with market conditions at any given time. And so those deals tend to be steady, and the valuations tend to be steady, and they've remained so. As Jason said, a lot of activity in 2023, not a lot of closures, but 2024 has been it's been the same. Still the same amount of activity, and thus far in 2024 has been a significant number of uptick in closures as well.
Right, and
Steve makes the point that there's no meme stocks in the middle market. It tends to be steady and largely driven by business fundamentals.
Right, and it seems like, and we'll get into this more shortly, but we're going to have potential changes in taxes, tariffs, interest rates, immigration policy, energy policy, probably antitrust enforcement, which may or may not affect some of the middle market deals,
right?
Health policy and others. So it may depend on the industry that you're in and how you're sourcing your supplies and what your markets are and those types of things. But I think as a general matter, talking about the middle market being in a more stable place and looking at fundamentals is probably the outlook that you guys are overall looking at.
Yeah, I would agree with that. I think that, there's lots of talk about changes to the FTC and SEC. Those the people who run those groups don't have to resign. Traditionally they do. And if that does happen, there will be some change in direction for regulatory environment from DC coming in. But as Neil pointed out, the FTC doesn't really regulate middle market deals as closely or provide as much scrutiny to the large market deals. So will there be an impact? Yes, but not as dramatic in the middle market. And again, it goes back to my point earlier. There's continuity or consistency in that marketplace over time.
Okay. So Dirk, let's focus in on one area that we mentioned, and that is the impact of the election on the potential sunset or extension of the tax cuts from the Tax Cuts and Jobs Act from Trump's first term. They're due to expire at the end of 2025, and unless extended by Congress and the president. If there's a Republican Congress, a lot of prognosticators say that they will be extended in various ways, and maybe there will be additional tax cuts. So looking to hear what you have to say and what you're advising clients and how they should be thinking about those policies and the planning considerations that they should be thinking about now as we go into the new administration.
Sure, Neil. So as you pointed out at the beginning, the House outcome is still not called, although Republicans are favored with a few races still yet to be counted. And so assuming for purposes of this discussion, as the polls seem to certainly indicate, that we're looking at single party control in Washington, it means that there should be little issue or problem with passing some of the proposed tax cuts that Trump has spoken about previously. So to go into detail what those are, the first would be an extension, making permanent the favorable provisions under the Tax Cuts and Jobs Act, the TCJA. The individual provisions that will be most important for today's discussion and for the business owner include things certainly such as the estate tax exemption. Now, keep in mind, this exemption was effectively doubled with the passage of the TCJA and is now currently going into next year, 13.9 million per person. It's 13.6 million this year. It indexes up every year. The prospect is making that exemption permanent, such that it doesn't revert, as once feared, to the lower level of essentially getting cut in half. What does that mean for the business owner contemplating planning? And when I say planning, I mean estate planning, but I want to emphasize too that planning should also be thought of for other tax reasons, such as income tax, as well as non-tax reasons. So the first takeaway we're telling clients is, first of all, we acknowledge that there is not the race to get planning and done to use large exemptions by making gifts under the prospect that they may no longer have that ability come 2026. That said, I feel the advice that we've been giving clients all along still stands. And that's always been, if you find that your net worth, when you look at all of your assets, is handsomely above the exemption, and for a married couple, that would certainly be doubling the exemption. So as we look and talk to clients who have net worths, including their business, well above, say, $28, $30 million, those taxpayers are already facing an estate tax, and they need to expect that going forward, they're going to face it as well. So whether the exemptions remain in effect or not is largely irrelevant, certainly when you're talking about an estate tax that currently hits at 40%. The other thing we've been telling clients, and certainly we'll be telling clients more so as they start.
Dirk, sorry to interrupt, but it's largely irrelevant if you're in that, 30 million and up level, right? Is that?
The fact is your need to do estate tax planning. What's irrelevant is the lack of concern to do planning, meaning that planning is alive and well for those taxpayers that find themselves well above those exemptions. The other thing that holds true is business owners should think about some of the non-tax reasons for doing planning. And these reasons always exist. The reason for creating trust could be to manage an inheritance for one's family. It could be to provide a legacy plan, making gifts to charity. It could be done for asset protection planning. It could be done to take advantage of income tax planning. And I'll give you two that we've been very busy with. One would be helping certain out-of-state taxpayers establish trusts for some of these non-tax reasons, but to do so in jurisdictions that don't have a state level income tax. And that can sometimes help alleviate gain on the sale, or even gain going forward on the sales proceeds in the invested portfolio. Another thing too, and a final thing, is under the TCJA, it enhanced the benefits for qualified small business stock. This is individuals who own C corporations, and it provided 100% gain exclusion up to $10 million, or 10 times the taxpayer's basis in their stock. If the TCJA remains in effect, that planning is great planning, and we've helped many clients not only take advantage of this small business stock exclusion, referred to as Section 1202 stock, but also help them to sometimes double or even triple those benefits through creative planning through trust.
Thanks, Dirk. And there's a lot more in addition to the provisions that Dirk mentioned. Potentially corporate tax rates going down. You could have marginal tax rates at least staying the same rather than potentially going up. Another big issue is whether we're going to have tariffs that the president or the president-elect has been talking about, and how that might impact various businesses. So we were talking a little bit the other day, Jason, about how some of these might impact things going into 2025 and 2026. How do you see that? I think your general thought was maybe some of the tax changes or the tax extensions at the margin may not have too much of an impact, but some of the other things, depending on your business, might actually merit some significant consideration.
Absolutely. So tariffs are one that I think for the middle market business owner and operator can have potentially dual impact. The first is if you're sourcing COGS, supplies, materials from overseas, and it looks like the administration is going to be particularly focused on China and maybe Western Europe to a lesser extent. You have to be prepared that the availability of those products and those supplies the price may be going up dramatically very quickly. And you already read some of the larger folks are trying to move some of their supply chain to other places or onshore, but that often is expensive and doesn't happen very quickly. The other part of tariffs, especially when combined with deportation and less immigration, is it may drive inflation, and it could do that very quickly. So as you look out into the future, into the next year or two, to start thinking about how you can pressure test and battle test your business to be more resilient to, on the one side, an increase in supply costs, and on the other side, in potential inflation rearing its head again.
And Steve, that there's been some discussion in some articles that I've been reading talking about, well, the prevailing thought was interest rates are going down, but maybe not. And particularly if inflation is going to continue for the next several years,
Right.
Potentially.
Well, the Fed lowered rates again last week,
Right.
and that should the consensus seems to be that should be the last one for a while. It seems that they've got inflation tamed at this point, and whether it's a soft landing or not is anybody's guess. But that at least the short term is that there's not going to be another change in interest rates anytime soon. So it's hard to predict that because it's involved in the politics of what's going on with interest rates as well. But there's doesn't seem that there's going to be any major changes to rates going forward in the short term.
Yeah, there's a lot of noise in the market. The 10-year T-bill has soared 70 basis points in the last 2 months. And the bond market is kind of predicting whether it's inflation or because of what they see as, and this was before the market, because they saw either a Harris or a Trump administration greatly increasing the deficit. And so the bond market is actually pretty aggressively signaling increased rates. but that hasn't kind of rippled through yet. And on the other side, you have the stock market hitting all-time highs. So I think to Steve's point, it depends who you're listening to, you know, what signals you're listening to.
Right. And to your point earlier, Jason, it's sounding like, and I know we're seeing this here at RCCB as well, you know, certain industries and certain businesses and deals are getting done because people have taken into account the current interest rate environment, whereas it was a little frozen, you know, a year or two ago.
Yeah, look, I remember a time when money wasn't free. You know, my first mortgage in the 90s and things like that were quite a bit higher than the rates are now. And I think private equity, the financial buyers are very sensitive to rates, and that's how, in part, how they generate their returns. And it took them a while to get comfortable that, you know, this interest rate environment and money isn't as cheaper as or as free as it was for kind of an unusual 15 years is here to stay. And they've kind of reset their expectations and their deal making accordingly.
Right. Another area that, I mean, we mentioned tariffs, we mentioned immigration, energy policy, you know, the drill, baby drill theme that the president-elect has been talking about for a long time. You know, so for certain companies that are either dependent on energy or selling energy, you know, I would imagine that that's going to potentially have a big impact.
Yeah, it doesn't. You know, the impact is like most policy decisions. There's a positive and there's often a negative to certain industries. I mean, what's positive to the oil industry may be negative to the clean energy industry. And you know the companies who've been impacted by the Clean New Deal, and so there's always two sides of the coin with any change in policy from any administration. You gotta kind of factor all those in. It's the same thing with the tariffs and other things. There's positive and negative impacts of the tariffs, and you just take a look at both as they weigh you know, how it affects their business.
Yeah, and certainly we've seen in the past you get depending on federal and state policy, you'll get certain bubbles, right? I mean, I know you guys do a lot in New Jersey, and the solar market was red hot there about what 10 years ago, and it's probably still decent, but not nearly what it was. And so, you know, those types of changes can make a big difference, but they can also be relatively short-lived. So we'll just have to watch and see, right? I mean, that's
As an example, New Jersey had an exemption on sales tax on purchasing EVs, which expires at the end of this year. So if they don't extend that, it'll surely have a somewhat chilling effect on EV sales.
Yeah, and I know the president-elect spent a lot of time in Michigan talking to the auto companies there about trying to, you know, save jobs and grow jobs there. So, you know, that will likely be, you know, a focus, electric vehicles and the transition away from oil and gas, but that's probably not coming as soon as it would have had the Democrats won the election.
Right. And he also, in trying to read the tea leaves, right, he also has a close ally and advisor who is the father of the EV industry, right? And Elon Musk. So
there are some countervailing factors there.
time will tell.
Yeah. And we'll see. I mean, you know, the foreign policy team is taking shape now, and there were some, you know, differing views of what that might look like and differing factions within the MAGA movement on, you know, whether it's more isolationist or more international and you know, military oriented. And it seems like right now some of the recent appointments are more international oriented. So we'll see we're going to have to watch and see how that plays out in some of these economic and domestic policy areas as well.
I'd say one
It'll
thing
clearly affect companies that are defense. I'm sorry, Jason, go ahead.
No, I was going to say one thing we've been very successful at is Since COVID, the US economy has been the envy of the world. Despite what we've all been living through, inflation, everything, it's a lot better than virtually every other economy, including Western Europe. And we've seen real interest from Western European buyers and Chinese buyers in US businesses because they want to be in the US market. And that's where the opportunity, the energy, and the size is. So there's nothing I'm hearing that will kind of, maybe if there's security related issues with China, but there's nothing I've been hearing that I think would dampen that interest and that demand from particularly Asian and Western European companies wanting to acquire US businesses. That tariffs and things like that make it even more important and more valuable to them. Speaking of foreign policy.
Yeah. Well, obviously there's the elephant in the room with the wars going on around the world, Ukraine and the Middle East, and how the new administration will handle those and what impact those will have on the economic environment and deal making. One area we were talking about China, but another area is certainly the Middle East. And it was the Trump administration that ushered in the Abraham Accords. I think there was an uptick in deal making in the Middle East with some of the Gulf countries doing deals with Israel and others. So that'll be another area that will, I think, play out over time. And I don't know how you guys have been seeing things happening there versus what may have been happening before October 7th, 2023.
Well, it certainly affected the deal market for companies doing work overseas, and there's a lot of cross-border work that's being done on various industries, and this isn't just defense, IT, and cybersecurity. There's been a lot of uptick. We have several clients who are manufacturers who are sourcing product out of the Middle East and also selling product into the Middle East. Neil, you're absolutely correct. I mean, there was a lot of uptick in transaction type of work that took place after the Abraham Accords. It's definitely slowed down in the last year because of what's going on in Gaza and now in northern Israel. I would expect, the expectation is that if, with a new administration, does the policy change and do those wars get kind of dampened down some bit and go back to doing business? One would certainly hope so.
Yeah, we've been talking a long time about for many years about a new Middle East, and hopefully where there's an era of cooperation and business productivity for the whole region. Hopefully that will be able to come to fruition. So talking about timing, the right time to sell, and probably all of you could chime in on this, I would think. What factors should business owners consider in determining if it's the right time for them? And I think, Dirk, there's probably a tax angle to that, although Steve and Jason will from talking to them the other day, it sounds like they have a different perspective on that. But Dirk, do you want to talk about the tax view of that and the planning?
Sure.
View? Yeah.
Sure. Well, I think what you're really alluding to, and I always think of it as there's two things here. There's the individual needs to be ready, and that's their estate planning. That's the income tax planning. Those are financial projections of what their after-tax takeaway is going to be from the sale. It's digging deep into what are they going to do with their time after the sale. It's making sure they understand what that looks like, so that they're in the right frame of mind to say, yes, I want to put my company up for sale. And yes, I want to get serious of getting ready to sell my company. I think that in my conversations with owners over the years, until you can start to show them, moving away from the numbers and the taxes, but really start to show them what life might look like on the other side of a sale, you can't make that deeper understanding to get them moving. And then, of course, as we'll hit in this call, there's all the things that need to be done to make sure that the business is ready, right, for top dollar. So really focusing on those two aspects, I think, is critical, and looking at servicing the individual completely, as we do as say a law firm, with both our private client services group as well as our corporate and M&A and tax consultancy on the corporate entity end.
Yeah, I'd like to add, you need to talk to Dirk long before you sell your business. I'm sure, Dirk, you have people call you up and say, I just signed a term sheet. I now want to move my business to Florida to save on taxes. And you're the expert, but a lot of that planning has to be done at least in a different calendar year. And Dirk, I don't know if you want to, we
Yeah, no,
like
that
to see your business like you're going to own it forever, be ready to sell it tomorrow. And some of that tax planning and estate planning has to be done well before, a year or two before at the very least, or else
that's
the
true.
IRS it. Yeah.
That's true. There are still ways that we can help individuals, but often when they give us such a short runway, there's not as much advantages that we can give them. And that's largely, as you pointed out, because some of the planning, any good tax planning, whether it be individual or even corporate level, sometimes requires different interrelated steps that need to age. And to rush into that is not something where you can necessarily achieve the best result. Another area too, and we see this a lot, firms such as ours working together. One common area at the boundary is this idea of business valuation, right? And the idea of like, what is a business worth, is asked in different contexts. It's asked certainly in the context of, should I put my business up for sale? What can I expect for myself and my family? But it's also asked in the context of, what if like we gifted the interest into, say, trust for the family members? We need a value to base the gift on. And certainly it's to the taxpayer's benefit to get a value when that company has not realized its full value in the context of a signed letter of intent, right? Or isn't out to market. We want to make sure that we're getting early valuations before the deal starts to come together.
Yeah.
I'd like to, Neil, answer your first question, then Steve,
Right.
if you want to talk about valuation. So
Right.
in the middle market, the time to sell is almost entirely driven on personal reasons. When, as the owner entrepreneur, do you want to sell? When it's the right time in your life. It's not about timing the market or trying to gain some tax loophole or something like that. In fact, we occasionally work with a psychologist whose practice is entirely focused on working with entrepreneurs through the emotional journey of selling their business and what they're going to do post-close. So the idea of, well, I'm going to time the market, or I'm going to sell it before the tax laws change or something like that, it doesn't drive the decision. Those are ancillary parts of it. So Steve, I don't know anything more you want to add on timing or valuation.
Before Steve, you jump in on that, I want to encourage people to send in questions as we go. If you don't have questions, I'm sure I will, but and maybe others of the panelists will, but please do look to the chat function to send in questions. I do think we've talked about timing and valuation and things like that. And Steve, curious to hear your thoughts on that. I know Dirk hit on that a bit with valuations for estate planning and making sure that there's adequate time for that. Probably, Dirk, probably in a different. You want to make sure that you're doing it in a different tax year. And there's also important reasons to do that from a corporate perspective in terms of making sure that you have the equity in the hands that you want it to have, that you're incentivizing people in the way that you want to incentivize them. But Steve, your thoughts on valuation and timing and things like that?
I'll echo a lot of what Jason alluded to earlier. I mean, middle market, privately held business owners, the decision process is as personal as anything else. I mean, it's a big part of what's going on in their personal life cycle as well as their business life cycle to adequately go it. A lot of transactions are driven by random events. Some strategic buyer, some private equity comes knocking on the door and asked if they can buy the company. And a lot of that happens with a lot of our clients, but oftentimes it's the business owners themselves who have reached a point after owning the business for 30 or 40 years and growing it where they've decided it's time to do something else with their lives. And so it's a very, very, very personal decision about what they want to do. And as Dirk alluded to earlier, it has to be a thoughtful process to go through it. I mean,
Right.
Dirk talked a lot about getting all the documentation for estate succession plan done right. I would say that for a business owner, it's very important to kind of think through what are the potential pitfalls in a transaction and kind of eliminate those and do a fire drill on the company. Bring somebody like RCC in to do RCCB and to do a fire drill. I mean, do you own your IP? Are there agreements with all your customers? Are you licensed to do business in the states you're doing business in? Um, are there agreements with your key employees? You want to have agreements with your key employees. Just blocking and tackling things that when you run your business day to day, you don't think about, but have come up in numerous cases mid-transaction and cause agita, so to speak, in a transaction, and frankly, push some transactions sideways because they create insurmountable issues. So, I would advise any business owner at least thinking about it. Sit down with our, RCCB or somebody and kind of go through everything that affects your business and make sure all those agreements are tied down and all of your I's are dotted and T's are crossed before you think about selling the business. If that's all legal from a financial standpoint, we're advising almost every one of our clients to go through what's called a quality of earnings process and kind of tie down the financial aspects and make sure that you've got a financial picture that can survive diligence, which can be difficult at times, and kind of do that before you go to market. And make sure that you're on top of your numbers and every expense and every piece of every piece of revenue comes in, it can be accounted for properly.
Yeah.
Two
So,
things to add to that. Sorry, specifics that lately I've just seen a lot in deals that unfortunately tend to derail them is your sales tax, making sure Nexus state and local sales tax that you're paying where you're supposed to be paid, and where you haven't, you do these VDA, voluntary disclosure agreements, and it's all settled, and you're not trying to hand off a huge liability to a buyer. And the other thing is just paperwork on your employees. In this administration, I-9s and things like that may be even more important. And as you run your business day to day, they may be somewhat afterthoughts to you, but when you go through a sales process, these are the details that can really upset a transaction.
yeah, we've certainly seen sales tax in multiple transactions. The paper keep or bad record keeping on I-9s affect companies, and that could be really a world of hurt, because then you have to decide what to do about it. And so more lead time on that, the better. Also, I think maybe Steve or Jason alluded to this, making sure you have these are basics, but making sure you have your equity, your cap table straight. And I think that's not uncommon for us to see companies that maybe they promised something to a key employee, but it wasn't really documented, or maybe there was a founder who used to be involved but is no longer involved, but they weren't, the documentation around their buyout is not crystal clear or not. And we see a lot of companies where they were founded in whether it's 1990 or 2000 or 2010, and they have no paperwork on the company other than what's on file with the state, the charter with the state, or the certificate or articles of incorporation. But after that, there's no minutes, there's no bylaws, there's no shareholders agreement, there's nothing. And so sometimes that's easy to solve, and sometimes it's harder, particularly when you have, more people on the cap table, and potentially some promises out there that people will be looking to come back to you on, and then you'll have to decide, do we deal with it before, do we deal with it after if it comes up, but the more that you do that in advance, the easier it's going to be to deal with. Rather than having to do it in the middle of the deal or even at the end of the deal. A lot of these things will also affect the value or the valuation of the company, not just whether the company can get sold, but how much is it worth. So, I think Jason, you wanted to talk, or maybe it's it's your
Sure,
seat.
I
Both
can.
of you. Yeah. Yeah.
So we often get asked, how much is my business worth? And we have, mathematical exercises we go through that look at previous transactions and what's going in the market right now and similar companies, and can come up, and we sprinkle some of our own experience and just what we know is going on, and come up with a range. But ultimately, your business is worth what someone's going to pay for it. And a big driver of that is just what, Neil, you were saying is, does the business look like quality? Is it put together? Are the back office, are the numbers intact? Is everything tied down? That will create more value. A buyer will look at that and say, I'm buying a quality asset here. And that helps when we bring a asset or a business to market. We show off the key points. We try to show, why is this business different? Why is it especially exciting to buyers, and create that tension in the market and the auction process to get folks to want it. So that's what ultimately drives the value, not a mathematical exercise that we go through here.
But you have to keep in mind that it's going to be different, it'll be valued differently to different groups as well. Each group that looks at, whether it's private equity or strategic or foreign, will have a different reason they want to purchase a business. They want your customers, they want your people, they want to be in your market, they want your product, they want your service, or some combination thereof. And we need, part of what we do for a living is understanding what those buyers are looking for, and making sure, as Jason said, we give it back to them in a prepackaged, easy to understand format that'll highlight those aspects to a buyer. We often highlight different aspects to different groups because we know what they're looking for, and that's part of what we're trying to accomplish. And it's a sales technique as much as anything else, but highlighting what makes the business valuable to a particular buyer is very important. And you have to understand what those aspects are, just as much as understand what the pitfalls are.
Yeah, the trends that you guys have been seeing in valuation over the last year in 2024 versus what you may expect to see in 2025 and 2026. And there's probably too many unknowns in there to really, and it may really depend on the industry and the company and the geography and what really happens with all these policies that we've been talking about. But maybe you have some thoughts that you could share on that from that perspective. I know Dirk was talking about valuation for estate planning, but how about what changes, what may impact valuation in the next year or two?
Everything we've talked about will affect valuation. It'll be, as you indicated there, Neil, it'll depend on the industry.
Mm-hmm.
And as I started the conversation, the good news about middle market is valuation doesn't change dramatically in the middle market. It has not historically changed in middle market. When I first started doing this in the early 90s, valuation for privately held businesses, they're relatively the same multiples we're seeing today. It just doesn't change that, which is kind of good
So
news.
you guys are not seeing wild swings, and it's hard to project wild swings in, going from instead of 3 or 4 times revenue, and some industries it may be less than that, right? To 6, 7, 8 times revenue, or getting in the teens
I
on
see.
EBITDA multiples. Yeah, go ahead.
Sorry, Neil. Overall valuations, they may go up and down, 1 or 2 turns, but very slowly. It's much more deal specific. I think what happens quicker, and part of what happened from 2023 to 2024, I think, was sometimes there's misalignment between value expectations between buyers and sellers. So I think part of what changed in 2023 to 2024 was sellers' expectations were a little more realistic, because some valuations kind of, COVID was a weird time, and some things valuations went a little haywire, and I think their valuations came down a little while the buyers came up a little bit. But we're not talking whole turns. It's just more mindset.
What we do see, to Neil's point, though, is changes in the perception of different industries.
Yeah.
And so, private equity is a copycat league. They're like the NFL. One private equity group starts to invest in a particular sector, they get 6 private equity groups following them, and that's just the way they operate. And so, there was an article recently in the Wall Street Journal that outlined a trend we've been seeing for a while. That's shirt sleeve industries, what they refer to. Contractors, plumbing, HVAC contractors, and the like, who service homes and service buildings that private equity wouldn't have even talked to you about 10 years ago. All of a sudden, they're consolidating that industry, they're putting multiple companies together, and they're interested in purchasing in that. And that's a trend that we're living today. Next week there'll be another trend in private
Yeah,
equity.
we're certainly seeing that on the legal side as well, with in HVAC and both home and commercial restoration companies.
Right.
Those are being highly sought after, not only in this region but really around the country, which is probably not something that people would have been thinking about a few years ago. So
Right.
we'll have to see what those industries are going to be, and I think some of the policies we talked about earlier could have a major impact on that going forward. I know, another example of an industry that's really been attracting a lot of private equity attention is the accounting world. And we've been involved in some of those deals and they've developed structures to allow for that as well. So I don't know if you guys are seeing that happening on your end as well.
We see a lot of consolidation going on. Accounting firms we work with have been consolidated or taken in private equity money. It's kind of strange times. They're not a typical private equity investment that you think of. Well, this is solid cash flow, lots of assets type of business. Accounting is very different. It may be kind of like a private equity acquiring a law firm from that perspective. All of their assets walk out the door every night. But certainly, there's been a lot of consolidation in that. They're getting economies of scale by putting these groups together and building up their practice and creating liquidity events for partners where none existed for years. So yes, it's a copycat league.
Yeah.
It's like
Medical too. Some fields like ophthalmology, dental, you see and I think, Steve, to your point, these are businesses that 10 years ago they wouldn't touch with a 10-foot pole. Assets that walk out the door, inconsistent revenue, things like that, and now they're rolling them up as quickly as they can.
Okay, so back to the election, guys. We're talking about, I don't know if you have any insights into who might be the Treasury Secretary, who might be the chief economic advisors, and how that might impact what we see going forward in some of the areas we've been talking about: interest rates, and taxes and tariffs and others. Do you have any thoughts on that, or is it a little bit too early to tell?
It's a little too early. I mean, something like the Federal Reserve Chairman, his term goes through 2026. Whether or not he'll resign, with the new administration, remains to be seen. Treasury there's been lots of rumors about people who supported the current, the new administration and the election. There's been names thrown out, but I don't think there's anything been announced by a transition team at this point and how that'll affect.
Is there any name on the list that you've seen that you think will send us in a totally different direction, or that would change the market perception of the administration? Have you seen anything like that?
The one person's name that keeps getting floated around is John Paulson, who made his fame as a hedge fund investor and is the person who actually did The Big Short. Made a ton of money doing that. So he's obviously a smart guy and saw opportunity where none existed, and has lots of experience in that space. How his appointment to Treasury will affect the overall markets. I think the markets will perceive him as positive because he understands the markets, how they operate. Beyond that, it's hard from sitting where I sit, how to see how it would affect it.
Yeah, there's certainly. Yeah, sorry. Go ahead, Jason.
I was going to say it's hard because Trump and the administration, they don't have a easily discernible, sort of consistent ideology. And his last administration, there was an awful lot of turnover. So, and Steve's point, like Paulson, seems like from what I've read in the paper, and I know nothing more, he's talking to a lot of kind of hedge fund guys and things like that. And they're usually pretty opaque. You know, I would have no sense of how they might act or see the economy as treasurer.
Dirk, any names in particular, or anything in the House, any that you're seeing could really have a major impact one way or the other from a tax policy or estate planning policy perspective?
I mean, if you're talking about the House, in terms of the fact that the race still isn't called, I really, as we sit here today, have nothing more than sort of the latest, which we, as you know, have been tracking. I think the question's going to be whether now or in the future, there's a mounting pressure, and there's a bit, there becomes sort of a division, even assuming it's a Republican-controlled House. And that might be mounting concern over growing deficit, mounting concern over other economic policy. And not all Republicans are necessarily in favor of, say, slashing the corporate tax rate down to 15% for producers who are, producing in the U.S. Keep in mind, TCJA took a dramatic decrease in the corporate tax rate from 35 to 21. So I just don't know. I think there's always that possibility that there could be some dissension and thus some compromise, meaning some of the stuff maybe doesn't get enacted. That said, it's anyone's guess, and we've seen things swing the other way too.
Yeah, and it seems unlikely at the moment, but if the Democrats were to have control of the House or take control of the House, how would that impact things, do you think?
Well, I think it's certainly going to be a more drawn out process. What would be an easy task of making TCJA permanent, and that largely would be all provisions, as well as perhaps a further reduction of the corporate tax rate, I think suddenly becomes something that's drawn out into late 2025.
Dirk, do you expect, and I don't know if you've given this, if you're able to tell at this point, but the proposals that came up during the campaign that where there's a lot of political mileage out of, excluding tips from income tax, excluding overtime wages from income tax, potentially excluding some additional Social Security income from income tax. Do you expect those popular proposals to survive? And how do you expect, if they do survive, how is the government going to raise revenue to offset that?
Yeah, those are good questions. If I had to guess, I'd say that the House is Republican. I'd say that in the first quarter, we see TCJA made permanent. Then I think we see coming out a slightly more studied review of some of the impacts. You mentioned no tax on tips, and certainly there's a fiscal concern perhaps of how that affects our revenue gathering. But quite frankly, and I've heard some pretty intelligent arguments, that also skews like the back end of, say, a restaurant. I mean, suddenly you have tax policy, which we know influences human behavior, and it can be quite structural in that sense. And you're artificially changing dynamics in the workplace. And so I think there's things here that even outside taxes need to be studied. And I'm not sure we see all of what's been preached on the campaign trail.
I think if taxes aren't, if tips aren't taxed, we're all going to be paid in tips now, right?
Mm-hmm.
Call my salary a tip, and we're good.
Yeah, well, it will certainly bring up, there's, fortunately, I guess, for firms like RCCB, there's no end of planning opportunities that some of these changes might create. And we've seen that over the years, that there's definitely unintended consequences, and that there are different ways to to invest in or take advantage of these types of changes. Certainly saw that in the first Trump administration and we saw it as a firm. You guys may have seen it as well with qualified opportunity zones, QOZs. And, you know, that driving some capital formation and investment in areas where the administration was trying to encourage investment where it has not historically happened. Well, I don't know if Dirk, if you've looked at that, but I haven't heard anybody talk about that recently, the qualified opportunity zones. But I think we're getting close to the, you know, the 10-year period, right? On those. Tim Scott, who was the Senate sponsor of that, I think is going to probably have, you know, heightened leadership role in the Senate. So there may be some more of those types of ideas coming in the future, particularly if Republicans do in fact retain the House. So I see we have about 3 minutes left. Maybe each of you wants to give you know, 30 seconds to a minute on closing thoughts. And Steve, do you want to start with that?
Sure, I'd be happy to, Neil. Thanks again for including us in this webinar. Appreciate the opportunity. You know, I think like with any change administration, there is disruption to the marketplace. There is uncertainty in the marketplace. So it's a different type of uncertainty that took place before the election. Now it's in place, it's you know, creating opportunity. That alluded to earlier, there's changes in the potential tariffs are increasing opportunity for different businesses. I listened earlier to Bob Nardelli on Fox Business, Bob is the former chairman of Home Depot and of Chrysler, and he was talking about, you know, companies who are sourcing product or manufacturing product in Asia are switching countries, and the opportunity that's created for some companies. It is disruptive, obviously. I listened to Kathy Wood yesterday, who's with investor hedge fund ARK Management, talk about the changes to the overall proposed by Trump administration. It was making the analogy to what happened when Reagan came in 1980 and how that over affected the economy. And so, you know, I tend to be bullish as to what's going to happen with the economy. I think that's what, you know, the American electorate voted for was based on the economy. And so I think that what's going to happen, it'll be a priority of this administration. I think that's what we're going to see. We're going to see positive impacts from it.
Thanks, Steve. And Dirk, do you want to weigh in, and then Jason, you'll have a window.
Sure. Well, Neil, I think at the risk of sliding into cliche, I think I almost can't sum this up better than to say something such as the only constant is change, right? And so we've seen this before. We know how to react because we're planners. And I think having clients recognize that despite whatever the winds are blowing in Washington, in terms of whatever tax or even policy perspectives that are coming out, and to guess what those implications are for their business, I think the best way to do that is in a structured conversation with their advisors. And so for that, you know, I'll end with the following. I think all clients need to really take stock of what they have, where they're going, and like any good time, now's a great time to have these conversations.
Thanks. And Jason, do you want to bring us home?
Absolutely. So change is inevitable. I think we're going to see more change over the next couple of weeks, months, and years. I agree with Steve, just based on Trump's background and demeanor, it will probably, or he's going to try to drive economic growth and activity and profitability. And that should augur well generally for businesses. But the most important thing I'd say that I do here at DAC, and anyone running a business, just keep your eye on the ball. Don't get distracted. Don't hope there's going to be a change that doesn't happen. Keep your eye on the ball. Focus on the fundamentals of your business, because ultimately in the long run, that creates real value.
Right. With that, it's a wrap. Thanks everybody for joining us, and we look forward to working with you going forward.